we've evidenced both physical demand and ETF inflows. And you know what we think about these ETF inflows. We'll look at that as well. Now, the physical demand element is notable as it's consistently evidenced the sovereign institutional size buyer that we've reported that's been very active since December the 15th.
We pick up the thread on this, especially as we also have fresh geopolitical drivers.
Shane, great to be with you again, my friend. Let's start there. That's always a good place to start. Look, even before today's, today we're recording this on Thursday. Geopolitics kicked off. We had a Russia incursion overnight. Crazy markets, obviously. But even before, and I think it's important because let's drill down into where we are, where we're going, all this kind of stuff. But even before today's major geopolitical escalation, we'd already evidenced 5 consecutive spot gold fixes that settled just below and just above 1900. Even yesterday it was over 1900. In fact, 1900, then 1904, and today, which haven't even checked where we fixed, but probably about 1930, and because we've just fixed it a second ago. And the last, this really started the first sort of fixes that moved above the old range started really a week ago on the 17th. It's Thursday the 17th. Here we are, Thursday again. And this is well before, it's important to say, this is well before the geopolitical escalations impacted gold. Now, into this rise in gold prices, we've evidenced both physical demand and ETF inflows. And you know what we think about these ETF inflows. We'll look at that as well. Now, the physical demand element is notable as it's consistently evidenced the sovereign institutional size buyer that we've reported that's been very active since December the 15th, which is they've been appearing at every single PM gold fix without exception since then. Now, we suspected, remember we've discussed this before, but we suspected it was Russia and China. But if you recall, we also reported a first-year LBMA bank squaring off all their unallocated gold contracts, which, given we had concluded our clients' transactions now, actually I can now reveal it was Goldman Sachs, who are undoubtedly facilitating supplying to sovereign buyers as well. Now, they're very, if anyone knows what's going on, Goldman knows what's going on. In fact, look, it's no coincidence that Goldman was out on Bloomberg early this morning saying gold came into this year undervalued. Coincidence timing? I don't know. And they're talking about it has great upside potential. And the interview came through even as gold crossed $1,950. Now, these sovereign buyers have not just been taking advantage of discounts since December the 15th of last year, but also buying into price rises, which is important. It's not just waiting for a discount. Now, and that culminated in yesterday's fix before Russia's incursion, and it fixed yesterday at 1904.70 before this incursion. And what was notable was that our liquidity providers said it was in very large size at this level. Now, clearly, somebody knew what was going on. And since then, geopolitics have been the drivers evidencing a risk on, risk off churn based upon really hourly, daily, even minute by minute news flows. And this is going to continue for a while. Now, recent liquidity provider confirmations of sovereign size demand being present really also jives with our first-hand information that we reported live here on Live from the Vault, that a first-tier LBMA market maker bank, which is now revealed as Goldman Sachs, had moved Basel III compliant after squaring off all their unallocated gold market credit risk. Now, while we cannot possibly confirm that the remaining first-tier market-making LBMA banks who are privileged to have gold accounts with the Bank of England, which are directly related to the BIS, of course, we can't confirm they've done the same, But it's very, very likely that by now they've become NSFR compliant. And we know firsthand that the second tier Swiss banks and trading desks we deal with had moved to adopt these NSFR standards shortly after the March 2020 EFP blow-up. And if you remember, we reported it at the time. Now, this has been a frustratingly long process, but it is underway. And Shane, as you know, our focus has been on the fickle, rinsable paper element of the current geopolitically motivated safe haven price ramp. So while this paper gold element has historically been very easy to flush out, the longer that the paper price holds above old prior technical resistances, the more technical damage is done, and it resets where the physical market will be able to underpin any sudden de-escalation dips, and which is when hot money dumps all their safe havens, race back into chasing bubble territory risk, of course, underpinned now by a wavering and very questionable Fed, actually, and especially this Fed put that's been in place. Really, the Fed is boxed here. I mean, to be honest, this is going to cause what's happening today is really going to accelerate really inflation enormously. Commodity inflation is going to go through the roof. So, you know, they're really, are the rate hikes going to suddenly go from 7 down to 3, down to 2? We don't know. Are we looking at rate cuts? We don't know at this point, because I don't think the Fed knows. Now, given that the COMEX-centric ETFs, which is GLD and SLV, you know, we've been focusing on it. They don't like the fact we're focusing on it, but we sure as hell are. We clearly know that these inflows are not yet Basel III compliant. And with both of these opaque flywheels churning unallocated gold and silver spot credit positions to the degree they cannot be considered to represent physical metal. Now, obviously, we've discussed how they do not assist. These ETF flows don't assist in discovering a real supply-demand price. Furthermore, these COMEX-related exchangeable positions are also subject to this hot money volatility. Now, real physical, once it's allocated and vaulted, tends to be very, very sticky. And it's not subject to really hot money volatility at all, thereby discovering and underpinning a solid physical supply demand price. Now, by weighing up the two separate markets, which is really what we try and do every episode, one is diluting the price, the other side is discovering it. And so by doing that, we can determine the dollar price level where Western central banks dare not push the price. And that's really because all that's doing is reopening the carefully managed hidden gold window. And the very same Bretton Woods window Nixon sought to close over 50 years ago. And what really is missed by most commentators is that Basel III is seeking to close this window, currently being competitively exploited by competing central banks and sovereigns who are busy exchanging their rapidly debasing dollars for physical gold, as if really what we're saying, this window is wide open. But by backing FX gold, foreign exchange gold, with physical, paper market dilution will evaporate. And we see the BIS positioning for higher gold prices.
Yes, Andy, as you say, there comes a point where the BIS will need higher gold prices. What are you seeing in the market right now?
Shane, really good question. And this is what we're seeing right now from a wholesale market perspective. It's so important. Putting geopolitics aside, it's this simple. Physical demand for gold for immediate delivery is overwhelming the ability to even forward purchase gold without attracting a very large premium. Now, the spot forward price allows one to spot index a number of ounces at the quoted spot price, like we just saw today. However, securing size comes with an increasingly large bilaterally settled premium to that price. Now, the larger the order, the higher the premium. So when exchanging gold for silver foreign exchange credit positions for physical for immediate, which we call T+0 delivery, or T+2 is acceptable as delivery, it's quite different for gold into an increasingly Basel III compliant NSFR environment versus silver. and silver. But silver and all commodities will also have to adopt NSFRs soon, because it's really still it is creating a problem on their balance sheet. Now, looking at gold, unlike silver, which at the margin has an industrial component that does not need to be hedged, actually, the industrial component doesn't need to be. It's going to be used. Gold has a known annual refiner production capacity. So based upon supply demand, physical gold is either hoarded, hedged, or divested, really largely based upon the daily precious, daily PM fix price, which we just saw a little while ago. Now, from the perspective of a sovereign central bank, or indeed a wholesaler, when acting for a client to purchase large physical gold, we initially purchase a long FX gold XAU position against the dollar leg in the very liquid multi-trillion dollar over-the-counter market. Now, locking in a price for a number of ounces, kilos, or tons at any point during an active session. It doesn't have to wait for a PM fix. However, at this stage, all this has done is lock in and spot index the price of foreign exchange cash gold against the dollar or the euro, etc., for this amount of gold credit. That's the point. That's all that's happened at this point. Now, out of the hundreds of tons of gold credit positions netted out and cleared each day amongst the LBMA member banks' books, it's only when standing for delivery that the gold credit position is crystallized into physical metal for a certain delivery time frame at really varying premiums above spot that you can negotiate. Now, for example, if after locking in a price, a client wants to obtain delivery of a spot indexed long gold, short dollar credit risk as soon as possible, they want to divest this and this risk as soon as possible, and secure the physical, versus agreeing out a much further delivery time frame, which may allow for a forward purchase to be married with a future supply. So obviously, in other words, at a lesser price, then obviously a bilaterally settled physical price must be agreed with a refiner, producer, or a bullion bank, right? So it's straightforward. However, the LBMA bullion banks act as a cartel. Now, we've talked about this before, and if one seeks large size and you shop around to fill several smaller tranches for immediate delivery, kind of under the radar, even if you're offering a large premium, the cartel will close rank and you actually risk being red flagged. Look, all metals credit lines at producers and refiners are ultimately provided by the banking cabal. So they can very quickly discover who the buyer is, and then one risks being completely blacklisted and cut off from future supply. Now, this is particularly evident in silver, where we have run into this issue, and we've reported this in the past, where we've run into issues with dealings with the LBMA and COMEX market maker Standard Chartered and UBS. They have far-reaching tentacles.